When the bear growls, even the most mighty of companies can find themselves in a free-for-all downside for their stock price. Tesla is one of the most popular stocks in the nation, and here I'm evaluating it by looking at earnings. And the thing I want to point out is, for fast growth stocks like this, earnings are not always the best metric. You might want to look at price to sales. Now, this still shows Tesla was very vulnerable because it was very overvalued based on sales, but it's certainly closer to fair value now than it has been. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Happily bringing you another subscriber request Tuesday. I've limited my selections this week to 15 selections. I've got about 42 different ideas from you guys, but I've limited it to 15 companies. And the kind of companies I chose to look at, some of them I wouldn't even have shown you anyway. They just have no fundamentals of which you could really analyze them with. But in the 15 that I've chose, I think each in their own unique way offer a teaching moment, because it's really an eclectic group of companies, as usually is when you guys request stocks. So we're going to go ahead and get into the portfolio. I want to remind everybody, I'm not recommending these stocks. In fact, many of them I would recommend against buying. These are the companies that the subscribers to this channel were interested in seeing. And so my job is to show them that, but also I want to show them how to think about those companies and how to maybe analyze, in some cases, some of those companies. So let's go ahead and get started. Number one, these are the 15 stocks that I'll be covering today. Of those 15 stocks, you have, as I mentioned, a very eclectic view. If I organize it by sectors, I've got 3 discretionary companies: internet marketing, automotive, and automotive manufacturers. 2 of those, Tesla being one, Winnebago being the other, and that's, of course, more of a motorhome company. I've also got oil and gas storage, asset management and custody banks, Capital One consumer finance, a financial exchange, ICE, the Intercontinental Stock Exchange. I've got healthcare services, application software, semiconductors. I've got 2 REITs, a residential REIT and a specialty REIT, and renewable electricity. So as you can see, quite an eclectic group of companies here. Now, as usual, I'm going to go through these in alphabetical order and try to give you some insights into how I would look at these companies and what I think of them. Now, the first one that we're going to look at is American Homes for Rent. Now, it is a residential REIT. So the first thing you want to do when you're looking at REITs is you want to convert to either operating cash flow, which is called FFO when you're looking at REITs. And this is very important because when you're looking at REITs, and I talked about this before, you've got 2 metrics that most analysts rely on. You've got FFO, funds from operations, and then adjusted funds from operations. Now, there are some differences, and there's also some similarities. Price to FFO is net income plus amortization and depreciation. All right. The good news is it's a standardized formula that almost every REIT uses. When you go into the AFFO, you get some different formulas. A lot of companies will actually measure AFFO differently, so there is no standardization. As a result, most analysts prefer using FFO as the standard. But as usual, when you're looking at these metrics, so here's American Homes for Rent, and we're looking at it on an FFO basis. Now, when you're looking at charts like this, the beauty of FastGraphs, as I've said so many times, is that it's a very dynamic tool. So a lot of times you want to get rid of some anomalous data and try to normalize the picture you're looking at. So I've gotten rid of a couple of years of data where we had some really crazy numbers, and I ended up with going back to the beginning of 2016. And what I've got here is a REIT that's growing FFO by about almost 11%. That's very fast as most REITs go. This is an investment grade rating, BBB minus company. That's kind of high for REITs. You won't see many that are, BBB or BBB minus rated. The normal price to FFO of this REIT's been about 23, and that's the blue line on this graph. So that's what normal. Now, I think that's a high valuation that we're given. Now, it's got maybe a quality premium. We have a big increase in dividends, as you can see, between 2020, 2021, and 2022. And then we've had more moderate gains since then. So you can see that spike up in the payout ratio listed here. And of course, that got the stock excited, and it got really above even its historically high normal PE of 23. It's now come back into reality. So arguably, this REIT would be quote unquote fairly valued based on how the market has been valuing the stock. It does offer a dividend yield of only 2.1%, however, which is relatively low as most REITs go. It has a FFO yield that's similar to the earnings yield of only 4%, so I would consider it highly valued. Now, interesting, when you look at AFFO, the formula gets a little better for this REIT. The growth rate's about 8.72%. It normally trades at 26 times AFFO. So either case, I think we're looking at a relatively highly valued stock. Now, and by the way, I'm using the soon-to-be-launched new version of Fast Graphs here, so you have to bear with me a little. I'm still struggling to know exactly where I'm supposed to go because it has some different navigation. But this is what the company looks like. If I use the normal multiple American Homes of 26 times FFO, then it actually looks reasonably priced today, as I mentioned earlier. If I use what would be a classic valuation metric, it's high. So I think the key is I don't consider this stock a bargain. I don't necessarily think it has such a great dividend. It would not be a REIT that I would be interested in today simply for that reason. And again, we don't use earnings for a lot of reasons. One of them I briefly alluded to the last time we worked. If I go into fund graphs and look at the in millions graph here, go to the income statement, you will see that I have diluted and basic shares outstanding. I want you to notice that the company has been issuing shares. They've been raising capital by issuing shares. So I consider that dilutive in nature, and also it's why REITs don't necessarily, you want to look at them when you're looking at them from the standpoint of basic earnings. You want to look at them for cash flow, which is what FFO and AFFO is all about. So anyway, there's American Homes. Ares Capital. Now here's another one that's very interesting. I want to show you how I make adjustments here. I automatically have a really crazy number here. I'm starting out at a very low PE and a very low price of only $375. So I think that gives me a distorted picture. So what I'll do is I'll call that number out. Now I've got what I would call a much clearer picture of Ares Capital. Now this is based on earnings again. You can see we've only had 2.35% growth. Now we do have an earnings yield of over 10%, and we also have a dividend yield of over 9%. This is clearly what attracts people. So when you're looking at high-yielding stocks, this is asset management and custody. If you're looking at stocks like this, you do want to look at operating cash flow. I don't see a lot of operating cash flow. I look at it from a standpoint of sales. It gives me a pretty benign picture, and I get a pretty good valuation reference here. And, there's certainly enough sales covering the dividends, but I don't see a lot of cash flow. Looking at EBITDA, which is earnings before interest, taxes, and amortization, I get a much better valuation perspective where the stock looks like it might be reasonably priced. But this is a high yield chasing type of stock, in my opinion. I wouldn't be interested in it because I do want to point something out. If I go to the performance calculator here, and compare it to the SPY ETF, I want you to notice it underperforms it in total return. It does perform it in terms of dividends. So one thing I think you could do with this stock is look at it as possibly as a bond alternative with a heck of a lot more risk than investing in a bond. But anyway, that's Ares Capital. You asked for that. Atlanta Sustainable Infrastructure. Again, if I look at operating earnings, this is a renewable electricity company. The price is all over the place. I think the best way to evaluate this would be looking at sales. And, if you don't know anything about this company, as I didn't, one of the things you can do is go into the company's website. And once you go into the company's website, you can learn a little bit about what the company does, go into the company overview. We're a sustainable infrastructure company with a majority in renewable energy. You can go into investors and look for, things like corporate presentations, and you can bring up those and you can kind of see what management is talking about, what they're doing, what their value proposition is, what their strengths are. But the problem is, and I want to emphasize this, the problem with a company like this, it's very, very difficult to value. It doesn't offer much in the way of upside in terms of future investment. The stock was overvalued. It's coming closer into valuation range, but you always want to make those decisions based on forecasts. Analysts are still not looking for a lot of growth from this company. What you're dealing with here is a company that's been all over the place. It's been trading more on, hype and hysteria. and optimism about renewable energy than it has on fundamentals. So I take that into consideration when you were looking at it. The next one I want to look at is Crown Castle International. Now, this is more of a traditional company. It's, again, a specialized REIT, does cell towers and a lot of interconnectivity communication based on price to sales. You can see it's been trading for the last 3 or 4 years at an excessively high price to sales. So I consider the valuation very, very high. It is a REIT, so if we look at from funds from operations, you can see it only started paying a dividend in December of 2014. Has a nice dividend record, decent dividend yield of 3.5%, but it's trading at normally, it's been for several years here in a 20 multiple range. I consider that a very high valuation for this REIT. And if I look at it through some of the appropriate metric, price to FFO, I get the very similar picture here. So I like this stock. I think the company's got a great future. What I don't like is the current valuation. I think this is one that would be worth waiting for. Now, based on a normal multiple, it looks attractively valued, but it only offers, minimal growth and a mid-range dividend. And again, I think the valuation here is relatively high. So I'd be careful with this one. The next one is Celanese. And that's, specialty chemicals company. And if you look at this company historically, it was kind of low growth for many, many years. Here I'm using price to cash flow again. I'm going to switch to operating earnings because I did want to make a point here. I want you guys that are subscribers learn to use this tool correctly. I always promote this as a tool to think with. It's an analytical tool. So when you're looking at a tool like this and you see a crazy number like this where you've got, huge percentage growth and start with a very slow starting point, go ahead and call that number out. Try to come up with what you would be able to look at and say, those are reasonable, relatively consistent growth rates. You've got little tricks you can do too. You can go to the forecasting calculator, for example, and you can go to the historical compound annual growth rate table, if you will. And what you can do here is a drop-down window. You can go to that drop-down window and look at all the historical growth rates. Now, these crazy growth rates are simply unsustainable. You need to know that. So you're trying to determine what's a normal growth rate, 14, 15, 16%, 12%. Those are numbers that seem to make, some sense. So if I go to the estimates tab, analysts are expecting this to grow by 4% going forward. Long-term growth potential, they expect to be about 3%. So there's where you would want to make your adjustment. That's what you'd want to be looking at, relatively flattish growth. Now, having said that, the company's probably reasonably priced here in terms of, valuation. It does offer an earnings yield of over 13% and a relatively modest dividend yield. But again, you have to, look for this company to trade at a higher multiple than it is for you to really make any money, because you're not going to get a lot of growth and your dividend is just barely above the market average. So take that into consideration. Analyze what you're looking at and try to evaluate the company as realistically as you possibly can. Capital One financials, very, very similar. It's in a position where it's been a relatively modest grower. For some reason, I don't really know what it is because I haven't researched it, but it really it got a real benefit off of COVID. It looks like we're coming out of COVID, but that seems to be settling down. And the analysts are looking at, a negative earnings year this year, which is really adjusting back to more normal earnings growth, and then relatively benign earnings growth going forward. The long-term growth for this company is only expected to be about 5%. So I'd be, cautious with this one. It's never really been a great performer. You can see for all these years here, you could have bought it and held it. I'm just picking arbitrary times and only made 2% a year on your money. So, I think knowing that kind of information when you're evaluating a stock is critically important. West Diagnostics is one that has obviously performed very well. That's healthcare services. They obviously do a lot of diagnostics, testing and so on. It looks to me like they got some nice pops out of some of the testing for COVID. I don't know about that positively, but you can check that out easily. This is a good, consistent company with a good, consistent dividend and a low payout ratio. It does offer a dividend yield in over 2% currently. You're going to go through this adjustment. That could always be something that could cause some turmoil going forward. So keep that in the back of your mind when you're looking at it. But I think this is a really high quality company. I think from the standpoint of forecast, remember, you always want to make your decision looking at these forecasting graphs. But there are some issues that, the analysts are seeing, and you want to check that out and make sure that, you're not stepping into a real problem here. But anyway, it's been a very good company. It's BBB+ rated, has reasonable debt, and prior to up to COVID, it's been a very, very consistent performer, albeit not a real high, fast growing. Next stock we're going to look at is the Intercontinental Exchange. The stock has traded, it's been just a very, very consistent grower, growing at a very fast rate. The orange line on here is a PE of 24. It looks very inexpensive based on its historical numbers, but when you're looking at forecasting, I would call it fully valued. They're forecasting growth to slow down to about just a little bit under 8%. Long-term growth, they expect to be just a little over 8%, and they being the analysts, of course, I'm referring to. But this is a really consistent performer, offers you a dividend yield of about 1.5%. Because of the velocity of growth it historically has, the company looks undervalued when you look at it from the long-term view. But then you start looking at it with, more modest growth rates, you start to recognize that we've got some valuation anomalies here. And so you want to make sure you're really comfortable that you're not paying a price that's going to be in excess of what the company's future growth is going to be. This is, Intuit application software. It's been a very, very popular stock, like a lot of big tech. You can see that the price, has gotten real high. It's an A- rated company, only has 29% long-term debt to capital. Very consistent performer. It's consistently increased their dividend, still has a low dividend payout ratio of under 25%. It got crazy overvalued, and now the bear market is bringing it back into reality. Now, once again, when you're looking at fast-growing companies like this, earnings growth of over 17%, sometimes a better metric to evaluate them is sales. But even on price to sales, this company still shows me that it is overvalued relative to historical norms. But again, as you adjust the time frame, that picture gets a little better. Sales have been growing at a really nice rate here recently, and the company is now starting to come into fair value. But use the tool and use the applications you have in the tool, the dynamic applications, to run things and look at them differently. Here's another one, Mercadolibre. I'm not sure how to pronounce that. This is internet and direct marketing. This is the classic case when I'm referring to the earnings haven't been very hot, but the stock price has been. And of course, now we're starting to see it come into a correction. It doesn't pay a dividend or a very low earnings yield. When I look at it from cash flow, I get a pretty good valuation reference, but even on that standard, it was very overvalued. When I look at it on price to sales, now all of a sudden I got a picture where the stock looks cheap historically. I'm looking at the future, growth is still expected to be very high. So again, there's a lot of research to be done. I haven't done any on this stock, but if you're a growth stock investor, this might be one that you might want to take a closer look at. Monolithic Power Systems. This is a semiconductor company. They make a lot of power amplifier storage. You can go into the company website if you're not sure what the company does. Energy storage, LED lighting, illumination. This is kind of, all the new Green Deal type stuff. The company, looking at it here from price to sales, it looks massively overvalued. If I look at it from the standpoint of operating cash flow, it looks massively overvalued, but the dividend is well covered. If I look at it from the standpoint of operating earnings, it looks massively overvalued. It has a long way to go before I'd be interested in that. So just because the stock price has fallen, the story here is don't automatically think it's become a good buy. Oneok Oil and Gas Storage. This is a cash flow company. You want to look at these storage companies, like most of them, for cash flow, and you're really looking to see is the dividend being covered. Keep in mind, these are also, like I showed you with REITs earlier, they tend to be dilutive. They raise shares to raise capital, and that really affects the earnings, but I don't consider that one a great bargain at these prices. PPL Corporation, which is an electric utility. I want to point something out here. The growth rate is negative right now, but even if I use this scroll bar here and adjust it back to what I would call normal growth before it fell, this wasn't a very fast grower. A lot of price volatility, moderate dividend yield, 3%-ish, and it's got an earnings yield of only 4.5%. Again, you could look at this as a bond alternative, but there's a lot more volatility in a bond. But recently, the earnings were cut in half, and they took the dividend down from $1.66, which they froze it for 1 year-ish, actually almost 2 years, and then they dropped it, cut it in half almost to 88 cents. Now it's expected to grow again. I think this is not available right now for investment. I think it's too pricey for a utility stock that's going through obviously some problems. I covered Tesla. This is another one to show you how to use this tool better. you got these normal PE, which is actually a wacky number, mathematically correct, but a wacky number. So you want to take it off of the graph. You've got all these years here of, no earnings showing up. And then you've got a growth rate that's kind of abnormal. So you want to adjust this as you adjust the size. And I'm using operating earnings here. You can see more recently, growth has gotten a little better. In fact, it's gotten crazy, even more recently. And you can see why the normal PE is. So, it's hard to analyze this based on earnings. I think your best metric to use if you're really trying to stay grounded would be to look at price to sales for these fast-growing companies. I think Amazon's another, type of company you want to look at it that way. It was massively overvalued even based on price to sales, and sales have been very strong. It's now coming into a more reasonable valuation level based on sales. If you're a growth stock manager, you might want to take a look at it. Winnebago, you can see how clearly the stock price has tracked sales. If you look at operating earnings, all of a sudden we had, again, another COVID kick, I would think. But the key is, looking forward. What is the stock expected to do? And its earnings are expected to stabilize. And this could create some issues over the intermediate term. I want to make that clear. I do think it's a good company. I do think it's worth taking a closer look at. But again, it has a very modest dividend yield. It has not had a lot of growth historically. So, knowing the nature of the beast, so to speak, that you're investing in, I think becomes very, very important. Anyway, this has been Chuck Carnival. There you have it. What I was really emphasizing in today's video was how to use a tool to analyze what you're looking at. Just don't take a picture for face value. Look at the numbers, change the time frames. Try to get a feeling. Is growth accelerating? Is it decelerating? What's the future look like? That's what you're trying to do. Valuation is a puzzle, and there's always not one magic answer to that puzzle. Sometimes you always want to switch metrics. You want to use the appropriate metrics, and you want to try to come up with reasonable expectations for the company, growth rates and so on going forward that are reasonable and not necessarily relative to the past, because companies that have been fast growing for a period of time, for example, could be slowing down the bigger they get. Other companies could be very cyclical, and other companies just, find it very, very difficult to make money. So use your tool if you are a subscriber. If you like the video, this is my another subscriber request Tuesday video. Ring the bell, give me a like. If you want to see future companies, I'm going to, again, limit that to 15 or 20. There were several companies that you guys sent me this week that I just didn't think I think they would have been confusing to talk about. So I just tried to give you 15 companies that I thought even offered some teaching moments. I hope you enjoyed the video. Subscribe to the channel and subscribe to FastGraphs if you haven't already. It's a wonderful tool that can really help you, get through this idea of researching stocks, and you can do it quicker and faster than any other tool I know of. Thanks for watching.